You owe back taxes to the IRS or your state, and you're looking for a solution to deal with the debt. You've thought about the offer in compromise and have even tossed around the idea of bankruptcy. You call the IRS and they offer to put you into an installment agreement, but the monthly payments are too expensive. Are there any other options? Are there any other types of payment plans? The 7 types of IRS payment plans. That's the topic of today's video. On the other side of the break. What's up everyone? Adam here from Legacy Tax. We are the premier tax resolution firm in the United States. We've helped thousands of clients with unfiled tax returns, back taxes, tax liens, and of course, IRS levies. You don't have to fight the IRS alone. You can reach us at 1-877-538-9546. You can also check us out online. Go to www.levyking.com. We've also put out a free ebook called End the Tax Nightmare: Insider Secrets to Beat the IRS and Reduce Your Tax Debt. Inside the book we'll show you how to stop IRS levies, liens, and garnishments without paying the tax in full. How to set up the payment plan that you want, and not the one that they want. How to potentially settle your tax debt for less than you actually owe. Our book has been a top seller on Amazon for years and you can buy it right now for $19.99, but I want to give you a copy of the book absolutely free. Just go over to our website www.endthetaxnightmare.com and enter your name and email and we'll send you a copy right away. No charge. Not even for shipping. Totally free. Before we go any further with the video, please take a moment to subscribe to our channel and don't forget to smash that like button for the YouTube algorithm and hit the notification bell so you'll get a heads up each time we drop a new video. Okay, let's dive into today's content. If you owe back taxes, chances are you've considered an IRS payment plan as a means of resolving your tax debt. You've probably even gone online trying to figure out how much you'll have to pay. Today, I'm going to break down a few of the types of available installment agreements, also known as IRS payment plans, and touch on their pros and cons. First is the short-term payment extension. If you owe $10,000 or less and you can pay your tax debt plus the interest and penalties within 120 days, or 4 months, a short-term payment extension might be your best option. This plan allows you to make manageable monthly payments. There's no minimum payment and you're guaranteed to be accepted into this type of payment plan if you meet the criteria. You can apply for a short-term extension when you file your tax return or online at www.irs.gov. Next is the traditional installment agreement. If you need more than 4 months to pay and your tax debt, including interest and penalties, is less than $50,000, the traditional installment agreement may be for you. This is the most widely used type of IRS payment plan. You'll get up to 72 months to pay the debt in full and you usually won't have to provide any type of financial information such as bank statements and pay stubs. You can apply online or submit an installment agreement request, which is Form 9465. Link in the description below. Moving on to higher dollar amounts. Things start to become a little more dicey if you owe more than $50,000 in tax debt or you need longer than 72 months to pay the tax, plus the penalties and interest. Once you cross over this threshold, you won't be able to apply online and you might want to seek professional help. This is because the IRS will require that you disclose certain financial information such as assets, liabilities, income, and expenses. You'll likely have to prepare and sign an IRS collection information statement. And misrepresenting your financial situation here could bring its own set of problems. So be careful when filling out the forms, or just hire a tax pro to help you. Next up is the stair-step installment agreement. This is a payment plan where you pay off the debt over 5 years but your monthly payments will increase each year. This may be a good option when you can reasonably expect your income to increase each year, or when you have certain expenses that you know for sure will be paid off as each year goes by. For example, let's say in year 1 your payment is $100 a month. In year 2 you know that your car will be paid off, so you can afford to increase the payment to $500 a month. In year 3, your toddler will be school-aged, so you won't need to pay for daycare anymore. Therefore, you can increase the payment to $1,000 a month, which will pay off the tax debt in full, plus penalties and interest, within 5 years. The key with the stair step is you need to know that either your income is going to go up or your debt is going to go down, which will allow you to handle an increasing monthly payment. Next is the Conditional Expense Installment Agreement. When negotiating an installment agreement, the IRS takes your monthly income and expenses into account to determine your ability to repay your tax debt. Your monthly expenses will be divided into 2 categories: necessary expenses and conditional expenses. Necessary expenses are expenses that go toward your health, welfare, or the production of income. This is the so-called necessary expense test. Conditional expenses are all expenses that do not meet the necessary test. Despite this, the expense might still be allowed if the debt can be paid within 3 years. Let's talk about business tax debt. For small business owners, one of the worst types of tax problems involves payroll taxes. Payroll taxes are the taxes that an employer is supposed to withhold from his employees and pay over to the IRS on the employee's behalf. Companies get into trouble when they withhold the taxes but fail to pay the money over to the IRS. This is the worst type of tax problem because payroll taxes are the IRS's #1 enforcement priority, and the penalties here can be extremely high. There are a few different types of business installment agreements, but for this video I'm going to discuss the In-Business Trust Fund Installment Agreement. To secure an In-Business Trust Fund Installment Agreement, the business must agree to make monthly payments that are sufficient to pay the liability in full within 24 months or prior to the expiration of the time the IRS has to collect the debt. If the business owes between $10,000 and $25,000, it also must agree to make these payments via direct debit from its bank account. Handling payroll tax debt is probably not a do-it-yourself project. Why, you ask? Because if you can't negotiate a deal, or if the business is struggling and cannot afford to make the payments toward its tax debt, the IRS could essentially force the business to close down. The final payment plan for today is the Partial Pay Installment Agreement. A partial pay installment agreement is a payment plan that allows you to pay off a portion of your debt in monthly payments until the tax liability expires. You see, the IRS has 10 years to collect back taxes. All the debt has to be collected before the so-called collection statute expiration date. Anything that is not collected before the collection statute expiration date becomes uncollectible. For example, let's say it would take a payment of $300 a month to pay off your $36,000 tax balance before the collection statute expiration date, but we can demonstrate to the IRS that you can only afford to pay $100 a month. The net result is that you would only repay about $12,000 of the debt, and the remaining $24,000 would become uncollectible. The partial pay installment agreement is one of my favorite strategies to help taxpayers with IRS problems. I like the partial pay because it effectively gets you out of a tax problem without paying the balance in full. It's kinda similar to an offer in compromise in that way. However, it's different from an OIC because it can be accomplished a lot more quickly and with less hassle from the IRS. Okay, we're getting close to the end, but before I wrap up this video, I want to answer a couple questions that I get all the time about installment agreements. The first question I hear a lot is, what happens when you and the IRS don't see eye to eye? Can the IRS refuse an installment agreement proposal? The answer is absolutely yes. There are 3 reasons the IRS might reject a proposed installment payment plan. Number 1, if the IRS deems your living expenses extravagant, they will deny your payment plan proposal. Whether it be charitable contributions or large credit card payments, should the IRS complain about your living expenditures, they'll potentially refuse your offer or demand that you pay more. Number 2, if the information provided on your Form 433A or collection information statement is untruthful or incomplete, the IRS may assume you're hiding income or property. Number 3, if you have already defaulted on a prior payment plan, the IRS may be hesitant to accept your new proposal. The second question I get all the time is, can the IRS revoke my installment agreement once it's already in place? The answer here is also yes. There are cases in which the IRS may revoke a taxpayer's installment agreement. While you and the IRS are both bound by the agreement's terms, should any of the following be true, the IRS may revoke the payment plan. Number 1. The most common reason that the IRS defaults a payment plan is that you didn't make your payments on time and in full. If you miss a payment, the IRS could revoke your installment agreement immediately, but they usually wait between 30 to 60 days before revoking the payment plan and usually give you a warning or chance to reinstate the agreement by paying the outstanding balance for that monthly payment. Number 2. The second most common reason has to do with your tax obligations. If you fail to file a tax return or fail to pay future income tax bills, the IRS can revoke your installment agreement. Number 3. If the IRS discovers that you knowingly provided incomplete or inaccurate information as part of the negotiation, there's a good chance that they will revoke your installment agreement. Alright guys, I hope you can see that there are many different types of IRS payment plans or installment agreements that can be used to pay off your tax debt. Speaking of tax debt, I want you to know that there are special programs in place to help you get a fresh start. But how do you know if you qualify? No two cases are exactly alike, so how do you know exactly how much you can settle for? Well, I've created a free tool to help get you qualified for a fresh start. Just head over to www.levyking.com or click the link below. Follow the prompts and answer a few simple questions and we'll help you figure out your eligibility. That website again is www.levyking.com, or you can give us a call at 1-877-LEVYKING. That's it for this week. Talk to you later.